Well, hello, this is Chris McAlpin, and I hope that you're doing well. I want to give you a quick update on what we're seeing in the markets, what changes that we're making here at Sound, and what we expect in the future. First, this year started off crazy. As the year 2021 kicked off, it started off just as crazy in the markets as 2020 left off, and that should not surprise any of us. We were just looking at the Saturday Night Live skit explaining NFTs, the non-fungible token, which is the new digital authenticator, which is probably going to be used to authenticate art form. One just sold for $69 million. Now, if you want to get thoroughly confused and not educated at all, but really laugh hard, yeah, go look at the SNL skit. I'm not claiming that it's PG-13, okay? Now, meme stocks have also taken off, and what the heck is a meme stock? These are stocks that are moving up and down based on social media hype. Nothing more. Has nothing to do with the value of the stock. So GameStop, AMC, when those stocks are taking off and falling down and taking off, all of it has to do with social media hype. And all of this craziness does happen from time to time in the markets. I got news for the millennial generation. It's nothing new. You didn't create it. Sorry to burst your bubble with that idea. And my generation didn't create it. You baby boomers, y'all didn't create it either. Been going on for millenniums. And it happens from time to time. And you know what? Reality will eventually reappear in the stock markets. So in March, we've seen the markets demonstrate really a good old-fashioned rotation from growth stocks to value. And I know we've been talking about this since about October and November. Most of our clients should see this demonstration on your account statements, which is very good news. In late summer and fall of 2020, we chose not to chase those growth stocks that were taking off. Think the fame stocks, Facebook, Apple, Amazon, Google, and Microsoft. And we talked back then about what a huge bubble that those stocks were creating. We're starting to see the NASDAQ 100 pull back. It's really flat for the year on 2021. And so we chose to rotate into the stocks like value stocks, small caps, and internationals. And we're now starting to see that rotation rotate into them. We wanted to get out in front of the markets. So I said this, I think, on the last market update. If you want an easy way, but it's imperfect, but you want an easy way to keep up with this, watch the Dow Jones Industrial Average versus the NASDAQ, okay? And you will see this oscillate. It's not going to be perfect every day, but over time, you'll see the Dow growing and the NASDAQ staying flat, or the NASDAQ could even sell off. And so also in March, we saw interest rates start to rise. The 10-year Treasury went up over 20%, at least when I did my homework for this episode, went up over 20% in March. Remember that when bond interest rates go up, bond prices come down. This is one of the reasons that we got out of U.S. Treasuries and we got out of investment grade bonds, because those have gotten banged up pretty hard in the month of March. Now, in the short run, this is going to cause some volatility. In the short run, it's going to cause some pain in the bond market. In the long run, however, I think we'll be able to build a better portfolio for our retired clients because we're going to get better yields from bonds in the future. And this has been one of the huge headwinds over the last decade, that low interest rate environment. So what are we doing right now? Currently, we're rebalancing almost all of our accounts that we manage for our clients, or manage for you. And this is simply a rebalance. It's a reconstitution of the stock sleeves. It's a realigning of your portfolio to position it in the right percentage in each category that we want the model to be in. Nothing more than that. It's not a rebalance. It's going to be a lot of trading, but it's not a rebalance because we're out of position. It's a rebalance just to keep the portfolio aligned. So don't be alarmed when you see a lot of that. What do we think we're going to see in the future? Now, this is where I always have to remind you, I don't have a crystal ball. I've searched high and low for one, never found one. Every time I've found one, it's cracked and it doesn't work, okay? But economic data is pointing to solid long-term growth. I've heard a lot of economists talk about $1 million jobs a month kind of growth in the coming future when the vaccines get pushed throughout the economy and the states start reopening their economies. We remember in our area of the world, Alabama to Texas, of course we have clients elsewhere, but and those of you that are elsewhere see this a lot more than we do. There's a lot of states that still have major shutdowns in place. as these economies open up, we should see a strong economic growth. There's a lot of economists that are saying, hey, we could see stronger economic growth than any of us have ever seen in our lifetime. That's fun to think about, because I hate the idea of 10 or 15 million people being unemployed. That's still the unemployment rate. It's a huge number. And so as those people start going back to work, as the economy reopens, as we get this new environment of some people working from home, some people working to work, I think we're going to see a lot of new and good opportunities. We see an infrastructure bill coming out of D.C. I think a lot of that mixes into a good economic picture. I'm excited to see that. Now, inflation will rise. I've gotten this question from a number of clients. We're going to have inflation. The Fed has already said they're going to let inflation run a bit. We're thinking we'll see 2.25%, 2.5%, maybe 3.5% at times. But when I say that, especially to our baby boomer clients, you're remembering inflation in the 1970s and the early 1980s. That was hyperinflation back then. That's not the type of inflation we're talking about. Healthy inflation and solid inflation is a part of growth. And we should see that in the economy, and we expect to see that. All in all, we like what we're seeing. Like what we're seeing in the markets, like what we're seeing in the accounts, and like what we're seeing in the economy. Your advisor is happy to discuss any of this with you. Give them a call, have a conversation, make sure you unpack that thoroughly. And listen, we appreciate the trust that you put in us. We know that it's valuable, that your money is hard earned, and we want to care for it just with that type of respect. And so appreciate you joining me today. Call us if we can help you in anything. Thank you.